Silicon Valley Bank (SVB) was one of the foremost financial institutions to be counted on regarding technology startups, venture capital companies, and innovation-focused businesses. In its years of glory, it had been supportive of the tech ecosystem, offering customized financial services like loans, credit lines, and deposit accounts. Notwithstanding, its collapse in March of 2023 was a sad example of financial attrition caused by bad financial management, external economic pressure, and a sudden run on its deposit by all of its fearful customers. The bank's insolvency has become the clearest such financial trouble of our times, pointing questions at the weak spots in the financial sector and the risk of mismanagement should any economic shock occur further down the path. We should know what is the financial distress. Financial distress occurs when an organization, company, or firm face the difficulty of repaying their debts and meeting their operating requirements, usually leading to declining financial performance, increasingly more liquid shortfalls, or even potential insolvency. For SVB, the financial problem showed up as an liquidity crisis when their bank could no longer complete withdrawal requests as asset value plummeted and liquid reserve turned inadequate, which brought about its failure and a federal bailout. The next is, what are the type of financial trouble in the case of SVB? SVB's financial difficulties can be categorized into three main types. First, corporate financial instability occurred as the bank itself struggled to remain solvent and operational due to its inability to manage its asset liability structure. Second, systemic financial problems arose as SVB's collapse triggered fear of broader instability across the bank sectors, particularly among regional banks with similar risk profiles. Lastly, industry-specific financial distress became evident as the demise of SVB had a significant impact on its main clients, which was technological startups, endangering their capacity to operate and maintain their financial stability. We move on to the categories of financial distress in the SVB case. SVB's financial hardships falls into multiple categories. It experienced a short-term liquidity crisis as massive withdrawals by depositors left the bank scrambling for cash, forcing it to sell long-term securities at significant losses. Additionally, it faced solvency problems with structural weaknesses stemming from an over-reliance on investment in long-term bonds that lost value as interest rate rose. SVB also displays operational distress due to poor risk management practices, such as failing to hedge against interest rate risk, and its overdependence on deposit from tech startups further exacerbated its challenges. Finally, SVB encountered a strategic problem as its investment strategy in low interest rate environments proved unsustainable when the Federal Reserve implemented aggressive rate hikes, reducing the value of its asset portfolio and exposing the bank to vulnerabilities.
Hello everyone, today I'm going to talk about Silicon Valley Bank, also known as SVB, and focus on two key areas. The first one is the stage of financial distress, and the second one is the causes of economic distress that ultimately lead to its collapse. This is one of the most dramatic bank failures in recent history, and is a perfect example of how a combination of poor decision, weak planning, and external pressure can bring down even a significant player in the financial world. Let me start with the stage of financial distress. The financial distress at Silicon Valley Bank unfolded in three distinct stages. Let me explain them one by one. First, there was the rapid growth and asset concentration. After the COVID-19 pandemic, Silicon Valley Bank saw a massive increase in the deposit from its primary client, which was startup and technology companies. The bank's total deposit more than doubled in just 1 year, growing from $62 billion in 2020 to over $120 billion in 2021. This rapid growth was impressive, but here where the trouble started. Instead of diversifying its investment, the bank placed a large portion of this deposit into long-term treasury bonds and mortgage-backed security. While these investments are generally considered safe, they are also very sensitive to changes in interest rate. This created an imbalance, as the bank's deposits were short-term, meaning they should be withdrawn at any time. But its investments were tied up in long-term assets that were not easily liquidated without incurring losses. The second stage was exposure to interest rate risk. In 2022, the Federal Reserve began raising interest rate to combat inflation. As interest rate increased, the market value of Silicon Valley Bank's long-term bonds dropped significantly. This is a basic principle of finance. When interest rates go up, the value of bonds go down. For Silicon Valley Bank, this created a major problem. While the losses were not immediately realized on paper, they become very real when the bank needed to raise cash. The declining value of its bond portfolio means that selling this bond would result in significant losses. The third stage was liquidity strain and asset liquidation. By early 2023, startup and technology companies were struggling due to reduced venture capital funding and rising economic uncertainty. To meet this withdrawal demand, Silicon Valley Bank sold $21 billion of its security, but this still comes at a cost. This bank reported a $1.8 billion loss from selling this asset. To cover this gap, Silicon Valley Bank announced plans to raise $2.25 billion in new capital. Unfortunately, this announced caused alarm among investors and depositors. Now that I have explained the stage of financial distress, let us take a closer look at the causes of Silicon Valley Bank economic distress. There are three major causes I want to discuss. The first cause is asset liability mismatch, which was the core issue that undermined the bank. Silicon Valley Bank used short-term deposit to fund long-term investment. This means they rely on money that could be withdrawn at any moment to support investment they could not easily cash out. When interest rate rose and depositors started withdrawing their funds, the bank did not have enough liquid cash to meet those demands. To raise this cash they needed, the bank was forced to sell long-term bonds at a loss. Imagine signing a long-term contract and then suddenly needing to break it. Of course, it comes with penalty. That is exactly what happened here. They lost a significant amount of money because the timing was completely wrong. The second cause is over-concentration of clients. Silicon Valley Bank relies heavily on clients in the technology and startup sector. In fact, more than half of its deposit, about 56%, come from this single group. Now, the problem with this is that these sectors are highly sensitive to economic changes. When venture capital funding slowed down in 2022 and 2023, these clients withdrew their funds at a much higher rate. If SVB have a more diverse range of clients, it could have spread its risk more effectively and be in a better position to handle this crisis. The third cause is loss of confidence. Trust is absolutely essential for a bank to function. When Silicon Valley Bank announced in financial losses and planned to raise additional capital, it sent a signal to depositors and investors that the bank was in trouble. This announcement sparked panic, leading to a bank run when the client rushed to withdraw their money. The loss of confidence was the final straw, and Silicon Valley Bank simply could not survive. In conclusion, the collapse of Silicon Valley Bank was caused by the combination of poor decision-making, risky strategy, and external economic factors. This value highlights the importance of diversification. Thank you for listening to my explanation. I hope it has provided you with a clear understanding of the stage of financial distress and the causes of economic distress that lead to the collapse of Silicon Valley Bank.
Next, I will be presenting the key consequences of the collapse of Silicon Valley Bank, which was the 16th largest commercial bank in the United States and a critical financial partner for high-tech firms and the healthcare industry. Its failure has triggered widespread implications globally, impacting financial market, borrowers, and depositors. Silicon Valley Valley Bank bankruptcy is expected to have far-reaching consequences for global financial market. The bank's failure has also had an impact on the United Kingdom financial market as the government is taking steps to reduce the damage to the technology sector, which relies significantly on SVB financing. Additionally, Australian equities market return increased by 1.41% due to the banking sector losses. Similarly, in China, the collapse of SVB disrupted many technology businesses and created uncertainty in the financial market as SVB was a key financier for startups operating between China and the US. In addition, SVB has joint venture bank and 2 subsidiaries in China. The fallout of SVB had significantly impact on the Japanese, South Korea, and Hong Kong stock market, which fell by 2.67%, 3.19%, and 2.81% respectively within 2 days of the event. Furthermore, the European banking index fell by 7%, dropping 120 billion euros from the market. Next is the impact on the borrowers. Silicon Valley Bank is known as the world center of entrepreneurship and innovation, with many startup technology companies that use and hold Silicon Valley Bank loan. It demonstrates that borrowers have a one-day abnormal return of negative 4.16% on the day of the bank failure event and a cumulative abnormal return of negative 13.47% in the 30-day period after the failure event. It can be concluded from the analysis that the borrower may face the default of the loan contract, resulting in the loss of the outstanding loan amount. Furthermore, with the collapse of the bank, the borrower lost the original source of money for the loan, and the borrowing enterprise may experience financial difficulties, making the borrowing enterprise unable to maintain daily operations and closing down. Lastly, we will move to the impact on depositors. The Treasury, the Federal Reserve, the FDIC, and other authorities took emergency steps to establish a new lending program managed by the Federal Reserve and funded by the Treasury to address SVB's issue while ensuring that all depositors were sufficiently safeguarded. According to the FDIC, each account can be insured for up to $250. However, despite the emergency plan, SVB depositors were unable to withdraw funds from the bank due to a significant cash flow shortage prior to the plan's implementation, and the flow of funds was limited. Additionally, any withdrawal of their deposit may cause SVB to fall into a rapid run situation, and depositors will no longer trust SVB. Depositors also want to withdraw all of their money as soon as possible, causing another shortage of cash flow due to the rapid run of funds, resulting in the damage of depositors' income such as delay payment. Next, we will move to the effect of the financial distress towards Silicon Valley Bank itself. HSBC Holding acquired Silicon Valley Bank UK Limited in March 2023 after Silicon Valley Bank faced a major financial collapse because Silicon Valley Bank had a deep focus on tech startup, venture capital, and innovation-driven industry, and was a trusted banking partner for a vast number of high-potential startups and its strong relationship with venture capital firms. By acquiring SVB, HSBC could instantly gain access to cutting-edge, high-growth companies in sectors like software, biotech, cleantech, and fintech. These companies typically have high cash burn rate and need specialized banking service, which present an opportunity for HSBC to offer tailored financial products and services in areas like lending, asset management, and investment banking. Additionally, the acquisition boosts HSBC's presence in the US market, particularly in regions known for their concentration of technology-driven companies. Silicon Valley Bank is the global epicenter for technology's innovation, and HSBC will further solidify its role as a key player in this important market.
Silicon Valley Bank's financial distress in 2023 stemmed from a combination of liquidity issues, poor risk management, and an overexposure to long-term securities in a rising interest rate environment. Here are potential solutions that could address financial distress in a similar scenario. First, they should strengthen liquidity management by diversifying funding sources,
asset rebalancing, and liquidity buffer. SVBs need to reduce reliance on short-term deposits and broaden funding sources to include long-term debt or equity instruments. Not only that, they also need to shift the portfolio from long-term, interest rate-sensitive securities to more liquid and short-term assets. In addition, SVBs should maintain a larger reserve of cash and cash equivalent instruments to handle unexpected withdrawals. Next, hedging interest rate risk. Implement robust hedging strategies using interest rate swaps or other derivatives to protect against rising interest rates impacting long-term securities. Moreover, capital injection. SVBs must seek equity investment from private investors, private equity firms, or sovereign wealth funds to restore capital adequacy and investor confidence. Other than that, must engage with government or central bank facilities for emergency funding, such as a lender of last resort program. Lastly, improve risk management. SVBs can conduct regular stress tests to evaluate the impact of economic scenarios on the bank's financial health. Diversify the loan and asset portfolio to mitigate sectoral and geographical concentration risks. The financial distress of Silicon Valley Bank (SVB) in March 2023 is a notable example. SVB faced a liquidity crisis triggered by a mismatch in its assets and liabilities, compounded by rising interest rates. The bank had heavily invested in long-term treasury bonds and mortgage-backed securities during a period of low interest rates. However, as interest rates rose sharply, the value of these securities fell, creating significant unrealized losses. At the same time, SVB's customer base, primarily tech startups, began withdrawing large deposits due to challenging economic conditions in the tech sector. To meet these withdrawals, SVB was forced to sell its securities at a loss. This revealed the extent of its financial strain and eroded investor confidence. News of the bank's financial troubles led to a classic bank run, with depositors rushing to withdraw their funds. Despite efforts to raise capital, SVB could not recover and regulators ultimately shut it down. This marked the largest U.S. bank failure since the 2008 financial crisis. The Federal Deposit Insurance Corporation (FDIC) took over its operations to protect insured depositors, and other measures were implemented to contain the fallout, including government assurance to safeguard deposits and stabilize the banking system. In conclusion, the collapse of Silicon Valley Bank serves as a cautionary tale of financial distress triggered by a combination of poor financial management, external economic pressures, and a severe loss of confidence among depositors. Initially, SVB enjoyed rapid growth, largely fueled by the influx of deposits from technology startups and venture capital firms. However, the bank made a critical mistake by investing heavily in long-term bonds without adequately hedging against interest rate fluctuations. As the Federal Reserve raised interest rates, the value of these bonds plummeted, creating substantial unrealized losses. This situation was when tech startups, facing their own financial difficulties, began withdrawing their deposits at an alarming rate. In response, SVB was forced to sell its long-term securities at a loss, which further eroded confidence in its financial stability. The bank's subsequent attempts to raise capital only fueled panic, leading to a classic bank run where depositors rushed to withdraw their funds, ultimately draining SVB of liquidity. Regulatory intervention came too late, and in March 2023, the bank was taken over by the Federal Deposit Insurance Corporation (FDIC). The consequence of SVB's failure rippled across global financial markets, affecting not only its depositors but also technology startups, venture capital firms, and international markets with ties to the bank. The incident underscores the importance of proper risk management, diversification, and regulatory oversight in the banking sector. While emergency measures were implemented to mitigate the fallout, the collapse of SVB remains a stark reminder of how misaligned financial strategies and external economic shocks can bring down even a seemingly strong financial institution.